the bell rings.
All right, here we go. Welcome. You're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And today's going to be a very busy day. We've got a lot of good stuff to talk about. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hahn from Pacific Private Money, California's fastest growing mortgage investment firm, Kathryn Harris, CPA of Parati and Karad, and financial and investment advisor Mike Zaidlin of Madrone Investment Advisory. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. You got it. We're giving away 9 vacations during this show. Vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Vacations are free. Only request a $75 cleaning fee to cover the housekeeping expenses. Today's trivia theme is business trivia. Okay, we thought we'd get a little bit of business here.
Not TV shows this time.
Not this time.
All right.
Okay. And no cartoon characters. I'm not going to do that for a while. Our website is bestofinvesting.com. Check us out on television, Comcast Channel 26 and AT&T Channel 99. Saturdays at noon, Sundays at 6 p.m. Kathryn, let's get right in with you. You got some planning stuff to talk about.
Every once in a while, I like to get on a soapbox.
Okay.
I don't know.
Keeps you clean.
And I'm here to tell you today that you thought your homework ended when you finished college. Maybe you did a little bit of some graduate school and you had to go a few more years. But it does continue to pay off to do your homework and to plan. I brought 2 articles in, 2 great examples of doing your homework or taking the time and energy to ask questions, research, meet with prospective consultants in the area that you are researching or thinking about going into. The first article is, are you sure you can't do better on that mortgage? And it goes on to discuss, you're buying a house, and not just any house, but a U.S. house, and the house is back, the real estate market is back and it's ready, and mortgage interest rates are going lower. And you go and you meet and you find the first mortgage broker that you either know, your family member, or somebody you found online, and you stay with them. And that's it. Whereas if you were to continue a little further, make a few phone calls and get some information, maybe you only generally have to provide, 10 pieces of information to get an idea of what a mortgage lender can offer you for a rate.
Okay, so even if you found an independent mortgage broker who theoretically should be shopping for you, you're still saying still even do some more shopping.
Shop some more, because we only represent a handful of lenders,
okay.
And you don't know who those lenders are. And ask the questions: how much generally do you charge? What are the estimated closing costs that you project? And again, you usually have if you know your facts, you know how much income you have, you know what credit card debt is, and
sure.
You know what your FICO score is, and you know what the home value expect to get. You give them those 7-10 pieces of information, they can give you at least a reasonable estimate of what they can offer you.
Fair enough.
And it can save you $15,000-$20,000 over the period of 30 years.
Well, you make a good point about independent mortgage brokers, because sometimes you hear that you want to go independent because they have access to hundreds, and some even claim that they have access to thousands of lenders. Well, theoretically that's true, but in practice, most independent mortgage brokers only use a handful of kind of their go-to lenders. So if you go to a couple of different independent brokers, that does make sense. And you always want to let them know too that you're doing that you're looking for the best loan, or you're shopping, because I know that as a mortgage broker myself, in the private money mortgage realm, I appreciate it when someone contacts me and makes it clear that they're looking for the best loan, not just that, hey, I need a loan, can you get it for me by Friday? And then I find out that I'm competing with 3 other people, and I've done all this work, and I'd like to know in advance.
It is, and that's kind of the next article too. Is when I meet with clients, I actually encourage it. But it is how I feel. I think it's good for the relationship to be upfront. To be upfront with disclosures, because if you don't tell them and then come Thursday, they say, oh, never mind. I mean, push on that relationship, all that work, and should they call you again, you may not put that energy in it.
Yeah, exactly.
So then the next article was, we saved $120,000 by stretching our IRA inheritance. Same conclusion, same idea, but a different avenue, different perspective. Generally, when
Mike's very good about stuff to know that.
exactly, and this is in his realm, is when you get an inheritance, you want to spend that money and you want to spend it quick. I was just talking with a client. They're like they're trying to buy a house and they're coming into some difficulty, and yet he's got some inheritance and he just wants to spend it, which is great. He's buying a house and he's good. He's not spending it, but especially with an IRA, and you can speak to it, Mike, too, if you've had this experience. Usually when people inherit that, they right away say, give me the money. Give me the money, I'm spending it, or give me the money so I can go do whatever I want with it. And they don't realize that it comes with a tax bill. And if they do some homework, some strategy, talk to their advisors, they can save a substantial amount of money and get the money that they want now, and save some for when they want it later. They just kind of think, I want it all right now, but then it's just going to turn around and go into an account that is.
Sure. I mean, I remember in the old days when I did some planning, I had one client, quote, win the lottery, and I don't remember how much it was. Maybe it was $1 million. And the idea at the time was just strictly to think about, what to do with the money. And the first thing I think I told her was, take $50,000 and just have fun with it. Get it out of your system, because the rest of it we're going to need to, get an income for you and all that. Because otherwise, you get an advisor who says, no, you just invest all of it. People feel like I'm missing out on something.
Well, to your point, Kathryn, about what you were mentioning about planning, had let's assume it was the parents who had sat down with the children and told them, and met with a planner, CPA, whoever, and said, okay, now this money, don't take it all at one time when you inherit it. Then they would have had some education in that, and that would have been where the planning would have come in a little bit, because once someone inherits it, they're not really going to look at that money as their own in a certain way. They're not the ones who worked and saved for it. So to them, it's just a lottery ticket.
Yeah.
And that's where planning, meeting with an accountant or a financial planner would have highlighted the need to have a communication about that before that event happened.
Well, isn't it amazing to hear about people who win the lottery and then are bankrupt within a certain period of time? And you're thinking, how in the world did that happen? And you usually take on debt or just.
Somebody out there has a statistic about that, and it's just unbelievably high for people who win the lottery, and then within a very short period of time, it's
like, I think actually professional players have that same. Within like 5 years, they have spent all of what they've earned in their professional career sports.
I think it was Mike Tyson one. He had spent like $100 million or something.
We did a refinance for a recently former NFL player, and when we reviewed his financials, like the $10 million contract that he had gotten like 5 years ago, the money was gone.
Exactly,
well,
and that just takes
you got to
it.
remember all the taxes that get taken.
Well,
out
sure, of
and
course.
the friends.
Well, the $5 million that was left over from the $10 million, right? Still, right? I mean, if you do 50% tax bracket, I mean, it's not like the government confiscates, 75% of the.
Well, Allen Iverson used to have an entourage of like 50 people. Suddenly all your friends come out.
Yes,
right.
and they actually
Vegas,
they want to be paid. Yes.
Yeah, it would be interesting to see of that $100 million that Mike Tyson, how much was spent on financial planners and accountants that
Yes,
should have
exactly.
been meeting with or listening to. Sorry, Mike.
Okay. He's making a comeback. He's doing his one-man show. Okay, we're going to cut to our first commercial break here. When we come back, Mike, I want to talk to you about tax-efficient investing, and then we got some good stuff from Mark, too. All right, so our trivia theme is business trivia, all right? How much did the first 3 minutes of a call cost when commercial telephone service was introduced between New York and London in 1927?
I'm sure a lot of listeners will know the answer.
This should be a multiple choice question.
It should be. Anywhere from $1 to $1 million. Does that help?
Can you give us 3 or 4 choices?
Okay, let's say 25, 50, 75, 100, or $125. Okay, that's your
Per minute?
How much did the first 3 minutes cost?
Oh,
how much did the first?
Wow.
Yeah.
I was about to give you some sense.
I know. It's
Yeah.
expensive. You had to have a little squirrel run across the line from New York to London. How much did the first 3 minutes of a call cost when commercial telephone service was introduced between New York and London in 1927. All right, stay with us because you're listening to the Best of Investing, and we will be right back. Yeah, you like those where I just kind of give this one? There could be any.
Yeah, I
I'm
mean,
gonna give you some.
$54.95.
Yeah. Oh no, I'm
like,
sorry.
like no one can possibly know that answer in an absolute sense. Like nobody.
That's why I gave you some. I figured. Oh, shit, I was waiting for someone to say, "Come on, give us some
Right.
multiple choice." Okay. So, Mike, when we come back, we'll.
They're the one with just the market. What the hell's happening?
Yeah, I just
Are you still
love that
working
they
on your
always
stuff?
think they know why it did, and I just, don't you love the headlines? They always know why the market went down or went up,
Yeah, after the
Right.
fact.
and
Tell
you
me
are a
anytime.
multi-billionaire now because you can, you know what if you know why it goes up and down every day, then you should be able to,
Should have
act
known
on
you
that it
it
was
shouldn't have to be
gonna go up
writing
and
this
down
at
that
that
article.
time. Yeah, right.
That's why, again, why don't we see a headline that says psychic wins the lottery?
He's melted through. That's why.
How you doing there, Mr. Kramer?
We went looking for a home, and my first stop was like that. I just partially because uneducated, myself included. Like I went looking, like with lending. I'm like, is that what lending tree's about? Like, are you supposed to? With mortgage brokers, I was like, I just can't. The entire industry confuses me.
Yeah, well, Lending Club. Those I don't think online mortgage origination is ready for prime time. I think you always want to go.
Go to Wells Fargo to start with. It's amazing how good they are. If you can get a regular home mortgage purchase.
Yeah, I learned I could not. I was like,
Oh,
oh.
Yeah, I still
then
can't.
you have
I
to
was
go.
like, denied. Well,
Oh.
I didn't know I was like, oh, I got the FHA or whatever that. Oh no,
I got a call today
they
from
don't
a
have
friend.
one for the San Francisco Bay Area
Oh, yeah.
prices.
Got a call today from a friend who was successfully able to get his credit cleaned up, except for one bureau and one derogatory. Because that one bureau is one derogatory, he can't get a home loan and close on the contract he's been in for 30 days to buy a new home. And otherwise, he's got a 760 FICO, and so he's calling me for a hard money bridge loan now. Because
That's an interesting story. You can tell that as the deal of the week.
Yep.
You ready, Mr. Kramer?
Getting there.
Still getting there?
I'm there. Go.
You're there. Okay.
He's there.
He's been filming us
All right.
surreptitiously. How do you pronounce that word?
Surreptitious.
There you
That
go.
could be a
Thank
trivia
you.
question too.
Yeah.
How do you
How do you pronounce
How do you pronounce
surreptitious?
this word?
Yeah.
Yeah, right.
It's like, where's the shirt? I can't say that. Okay, here we go, right? Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Comp, Kathryn Harris, Mike Zaidland. That's it. Okay. When we got to the first commercial break, we asked this trivia question. How much did the first 3 minutes of a call cost when commercial telephone service was introduced between New York and London in 1927? And we gave some multiple choice of $25, $50, $75, $100, and $125 for 3 minutes. So you know it's at least $25.
I'm going for 75.
I'll go 50.
I'll go 100.
And Mark Hunt would be correct at $75.
Ooh.
75, can you imagine $25 a minute?
Wow.
$75.
And that's in
Back in 1927. It's like, talk fast. Mike, before we get into you, we did say that we were going to have a special trivia contest here, and the winner's going to get a night stay at the Auberge on the Vineyard. So then we're located in Cloverdale of all places, situated at the confluence, I love that word, of three of California's greatest wine growing regions. Auberge on the Vineyard is the perfect starting point to discover the charms of Sonoma and Mendocino counties. Check them out at www.sonomabedbreakfastinwinecountry.com. That's a long one. Or you can call them at 707-894-5956. Looks like a very relaxing bed and breakfast to enjoy the wine country. You want to check those guys out. So here's the trivia question. Almost 40% of guys say they can't go for a week without this. All right, stop laughing. Keep it clean.
It's not that, right?
It's not that. Okay, and what's that,
Sports.
Mark? Yeah.
Sports?
Okay, and here are the rules. No previous winners on the. You want to get new winners on the Best of Investing, and you got to email edward@bestofinvesting.com by midnight tonight. The answer, and from the correct answers, we will randomly choose the winner and announce it next week. Okay, Mike, you want to explain or educate the audience about tax-efficient investing?
Okay, well that's a very, very, very broad subject, as Kathryn would undoubtedly know, being a CPA. But I see a lot of portfolios where, for example, someone has a Roth, a taxable IRA or 401k, or a taxable account, or all three, And I'll often see taxable bonds in the taxable accounts, which are taxed as ordinary interest. And if you happen to be at, say, a 30 or 40% marginal tax rate between state and federal taxes, you're going to give up, at least a third of that in interest, that taxable interest in tax. And yet I'll see stocks in their 401k or in their IRA.
Like growth oriented.
Exactly. Yeah, and of course you need both. Generally, almost everybody needs both. But the problem is that stocks, which are tax favored assets, because they offer long-term capital gains as well as qualified dividend treatment, are not being matched up with the tax favored accounts. The tax favored account is a taxable account or a Roth account. A very unfavored account is an IRA or a 401k, because no matter what the asset in there is, it loses its tax favored
It
treatment.
comes back out.
The
as
worst
ordinary
case,
income.
the worst case obviously being having a municipal bond in an IRA or 401k. And so it's not about the pre-tax return. The return you care about is the after-tax return, which goes without saying, except that it needs to be said because sometimes it's forgotten and not properly addressed. Yeah, and I'm sorry.
I was good. Do you generally have any recommendations of what would be a good composition? I would think that people have a tendency to say, I need to have a balance within my 401k, and they really should be looking at the entire portfolio. That's really what this point is. It's saying is you may wish to have a certain type of investment more in your 401k, whereas your Roth IRA or other tax or those that are just your general savings and after tax accounts.
Well, yeah, because you own both buckets.
Exactly.
It's a matter of which bucket you want to put that asset in.
And a lot of times, financial investment advisors pretty much just look at the assets they're managing. But that's a mistake because what the client needs is a holistic view. The client basically wants to get the most benefit from an after-tax point of view. So however that can be accomplished, it needs to be accomplished. So I always, even if I'm not managing a 401k plan for that client, I always want to know what they have, and I'll always put together a plan that puts it together holistically. It doesn't do the client any good to match up each of those accounts as if they belong to three different people. The other issue is marginal tax rates. That also goes into the composition. If you're a married couple filing jointly and you have taxable income under $75,000, you're depending on other things, not going to be paying tax on capital gains on your stocks because you will be in the 15% income tax bracket, at least to that level, and you will also not be paying tax on your qualified dividends. So essentially, you've turned that taxable account into a Roth.
Yes.
To a large degree.
Interesting. And then also you got to look at for older people the Social Security and the income that affects how much Social Security gets taxed.
Exactly. And that brings up the issue of money coming out of Roths, which does not count against Social Security, but money coming out of IRAs does, and can cause not only is your IRA, say, taxed, let's say, at around 21% or so, it's going to cause your Social Security, if it sometimes will cause your Social Security to be taxed at up to 85%. So the marginal tax rate of an IRA dollar is about 46% in that case.
And I've already made my predictions, which I've said before, is that, I mean, I did this 30 years ago. I said the going to tax Social Security because there's just too much income out there that they're not taxing. I said, and then, they said they
Now
came
it's
up
the
with
Roth
50%.
IRA, and they're saying, well, you'll
At
never
some
pay
point,
taxes on it.
Yeah, I mean, I think that they'll do that, but I think with Social Security they'll eventually do 100%.
Well, it's a good point, Edward. I'm not sure if you're aware of it, but Social Security is not indexed for inflation, so eventually all of it will be taxed unless it becomes indexed for inflation. Currently, it's broken out into 0, 50%, and 85% brackets, but they're not indexed for inflation at this point.
So if all this stuff is like me, making your eyes glaze over, it just shows that you really need a good financial planner on your team and a good CPA.
Or kill yourself and collect on your life insurance. Oh wait, no, that doesn't work.
Ah, darn it.
No, you can't kill yourself.
No,
Well, but as Kathryn
after 2 years,
You
you
have to
can.
die from relatively natural causes.
No,
after 2 years.
After 2 years, I think you can.
Incontestable.
Or maybe, is that what it is?
Yeah, but the problem is that you're not your own beneficiary. So
as Kathryn was saying,
Have fun spending it.
yes, exactly.
You're gonna have one fantastic funeral. Go ahead.
all right, as Kathryn was saying, it is about planning because by the time these things come to pass, it's too late to plan.
Yeah.
They have to be planned years in advance. have a taxable account and you're retired, you have bonds in them, and years have gone by, it's too late to get your stocks out. It's probably too late to switch. You are going to be stuck with a certain problem, especially as estate planning issues come along too, and you don't have something with a stepped up basis to leave to your heirs.
Yeah, the IRS doesn't like you go retroactively too often, do they?
Not at all.
Not too often.
So Kathryn, a question just came up. So it's January. So why should someone be talking and meeting with their CPA this time of year? What are you doing with your clients right now that you're kind of in between the tax rush?
Well, usually at this point in time, we've finished a lot of our tax planning for 2014. There's just not much you can do after year end.
A little bit.
Very little, but just like you said, Edward, there's not much retroactive that you can do that the government likes. But at this point, we actually are meeting with a lot of potential clients, and this is a great opportunity, a great time when, as you start the new year, this is when I also make you New Year's resolutions, and as you start planning and prepare yourself to have a very healthy financial portfolio, is meet with a CPA. Get to know
Start
yourself.
interviewing
Okay,
CPAs.
well,
There you go.
here we
Yeah.
go. Okay, so before we cut to our break, I do want to get right to your email that we received, which is, what questions should I ask a CPA if I'm thinking about changing my CPA?
You really want to know, it does depend. That's generally my answer for lots of things. But it really becomes, it's who you want and what you want out of your CPA. You want to know the size of the firm. Are you going to be dealing with just that individual, or is there more individuals who are working on your tax return? Some people prefer working on somebody who will know their entire tax return from point A to point Z, and they're who work by themselves. Others want a large firm. You also want to ask how are they compensated? Is it a hourly service that you pay for, or do you pay for per form? How much is it per
But
project?
that's a good point, because someone can meet with a potential CPA, and then let's say it's a little bit larger firm, and say, okay, I'm hiring you, and then it turns out that they end up working with a junior accountant or somebody, and it's like, wait, I really kind of wanted to hire you.
Exactly, it's that relationship, because it is. I find it to be a very personal relationship. You are dealing with something that can have a very profound impact over several years. I say you pick your CPA just like you pick your doctors, and how you pick your attorneys. You want to trust that individual, and that they think of you and consider you. We think of our clients and reach out to clients throughout the year when we find changes in tax laws or something that we benefit, or a new product that may be helpful to them. And you would want that. I would think we think our clients would like to have that. So those are exactly. You don't want to, when you go in, you want to know who you're hiring.
Okay. Well, did you want to ask?
I just wanted to point out, in my experience working with a number of different CPAs and enrolled agents, I really find a lot of variation. Some are largely just do taxes, and some issue spot and do more planning or alert their client more towards potential issues. So I really find a lot of variation.
Exactly, and that's kind of where it says it does depend. Because when I sit down, those are the questions I ask. Is what do you expect of me? Because I can do just your tax return if that's what you want, and some people just want that. There's just not a lot of complexity to their return, or to their estate, to their financial portfolio. Others do need that, and I can react appropriately based on that conversation. So that's one of the questions I ask.
One of the things I've often found is that I point something out to a client, and they'll say, "Why didn't my
CPA
fill in the blank estate planner,
yeah.
CPA, tax preparer, financial planner tell me?" And it's a hard question to answer.
Yeah, good point. So, Kathryn, if people wanted to interview, let's say you at Karate and Karad, how would they get a hold of you?
I can be reached at 415-461-8500 here in Larkspur Landing, and happy to take any phone calls or meet with you on a free consultation and get to see if I can provide a service to you.
Exactly. Fair enough. Okay, we're going to cut to our second commercial break. Again, the theme is business trivia. What was Henry Ford's first mass-produced car? The first three callers with the correct answer, you'll win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What was Henry Ford's first mass-produced car? That was not the Ford Taurus, I can tell you that. All right, stay with us, because the best of investing will be right back.
I have a guess.
And you're wrong. Oh, wait a minute, I don't know if I guessed it.
Could be a trick question.
The better trivia question is what colors was it
Black.
painted?
You can have any color as long as it's black.
Yes,
That's right.
yes, colors.
You know,
I don't think
The
anyone
shade
could-
of black or the shade of
I
black?
can't see anyone going to Henry Ford and saying, I'd like a soft pastel green.
yeah.
Hues of
Yeah, not nowadays. But when you said pick your CPA, like pick your doctor, I just had this
I
bad,
want purple with a little gray in it.
you know?
Picking your doctor?
Yeah, just, I don't know, for some reason I was thinking about proctologist. Like,
Oh,
that's
Mr.
not
Dutton, I didn't pick that one right.
That's-
It happens.
What are we doing next? Email time? Sure. All right.
Mark will go with your email. We'll go with you and your email. Yeah, it's like for me, I mean, I can represent, 1,000 different insurance companies, but you're not gonna find that much difference between a couple.
Yeah.
So I work with, let's say maybe 50 of them. For the most part, they're gonna be, one of those is gonna be about the lowest out there, and if there's one in Timbuktu that's a little bit shady that you don't even wanna know about,
Yeah.
that doesn't do you any good.
And that's where your value comes in, actually, I would think, is where you kind of say, you know what, I don't know this company. You want to make sure when you're paying somebody for insurance or paying somebody that they're going to be there 10 years from now.
Yeah, and again,
20
companies have been
years.
around for, hundreds of years, and they've always paid on the life insurance, but if you have an annuity with them, that's a whole different story. Or being a stockholder, totally different. With life insurance, you'll get paid. Yeah. But you still don't want to deal with a company that's, let's say, C-rated, because then it may take much longer to get paid. Oh, gee, we're in receivership, and, so it's better not to do that. Okay, ready? Here we go. Welcome back to The Best of Investing again. I'm Edward Brown, your host, and along with Mark Hahn and Kathryn Harris and Mike Zalin. When we asked, we cut the second commercial break, we asked this trivia question, business question. What was Henry Ford's first mass-produced car? And I know that Mark was trying to say, well, or Mike was trying to change the question to what color could you choose?
That's right. Model A.
No, it was not
B.
the Model A.
T?
C. Keep going.
D.
D.
E. F. G. T.
No.
No?
Keep going. You're
He's
running out of
she,
letters.
I just know the color.
Yeah, that's, yeah. What shade of black?
X?
All right, I knew it was a trick
No.
question.
AB?
It's not a trick. It's just a hard question. The Model N is in Nancy, which
What?
sold for $500 in 1906.
And it was mass produced.
It was the first mass-produced car.
Model N.
Wow.
Model N. That's a tough one.
Wow.
All right.
Say, what year was that? So I'm about to say.
1906. Yeah.
1906, okay.
Apparently my grandfather worked for him when he was like 14 years old and helped invent something that helped with the conveyor belt system, and basically pat him on the head, gave him a quarter, and he probably made millions off
Do
it.
we have your grandfather to thank for the entire U.S. auto industry?
No, not exactly. Okay, Mark, we have an email that we received for you. It says, I'm used to investing in deeds of trust, so we have an experienced investor,
Mhm.
but not in a fund. What are the advantages of investing in a fund?
Great question. So at Pacific Private Money, we provide mortgage-backed investment opportunities for the public, and mortgage investing, as we call it, some people refer to it as trust deed investing or investing in a mortgage pool fund, has been growing in popularity in this what seems to have been, endless zero savings rate period that we've been in for, over 10 years now. And so it's been around for quite a while. People have been investing in mortgages for decades, but it was really, for the most part, relegated to a very small segment of the population. In fact, interestingly enough, mostly like retired real estate professionals or existing real estate professionals who kind of knew this, so-called best-kept secret in the investment market, which was investing in real estate secured notes. Now, why would you want to do that? Well, in the private money lending universe, a private money loan generally garners about a 10% note rate. And if you wonder, who would borrow it at 10%? Well, there actually are quite a few people who borrow and are quite happy to pay 10% for the use of money for a short period of time. A typical example would be a contractor or a real estate investor buying, fixing, and flipping property. More recently, in the wake of Dodd-Frank and what's happened with the banking industry and how hard it is now for many people to get a bank loan, we've been making more and more loans to people who think they've got a bank loan, they're in contract, they've got a deposit, maybe the deposit's already even gone non-refundable, And then they find out from the bank, and I got two calls like this last week. The bank says, well, we found something on your credit and we're not going to be able to close in time. And now they're in a panic. So private money has actually become a plan B for the public who find themselves in a quandary. They don't want to lose their deposit, or they really, really want to buy this house. And so how can they do it? Well, the private money lending industry is out there as a plan B, as an alternative, and an opportunity for you to actually get financing in an environment that is so much easier than the banks. The problem is you have to pay for it. It's 10%. It's not 4% money. So with that backdrop of private money loans, the capital that we use comes from private individuals. And so the question was, this particular listener has invested in deeds of trust before. And again, if you don't know what that means, excuse me, that means that in California we don't have mortgages, although we refer to them as having a mortgage on your house. We're not a mortgage state, we're a deed of trust state. So it's a trust deed, it's recorded against the property, and that's what the security is that secures that loan against your home. And so you can invest in an individual note secured by a deed of trust. Another popular way to invest in mortgages is to invest in a mortgage pool fund. The difference between the two is largely when you invest in an individual note, first of all, you're competing with other investors who would also like to get that note. And in this environment, in our office, for example, oftentimes our individual note investors will fight over a note, and there'll be 9 disappointed investors and 1 happy investor because they got that note. So you're competing with sophisticated note investors. Also, they get paid off early. So you invest in a note, and 6 months later, the guy pays you back because, hey, it's usually a short-term borrowing situation. So that's,
And then your money has to sit at 0% interest
right,
or whatever,
exactly.
Waiting for the next loan.
So a mortgage
Right.
pool fund exists to, it's like a mutual fund of mortgage-backed loans. And so when you invest in a mortgage pool fund, your money is then pooled together with others. It's used to make loans, and yes, those loans get paid off, but the money then goes back out again. And so the fund manager utilizes this pool of funds as their source to fund their loans. And if you, depending on the type of company that you invest with, they may have a large deal flow like we have at Pacific Private Money. We're funding approximately $5 million per month, and the size of our mortgage pool fund is still small enough to where we can fund as many of those with our fund as we can, given its liquidity. And then when all of that money is invested out, then we go to our individual investors to see which of them would like to invest in that note. So the biggest difference is really with a mortgage pool fund, your money is working full time. You don't have to worry about early payoffs. Generally, you're getting a slightly smaller yield. So like, for example, our fund pays in the low 8% range right now, whereas if you invest in an individual note, oftentimes you can get 9, sometimes 9.5 or 10%, depending on your appetite for risk. So really, it's the answer to the question is a little more complex, and I could spend the entire rest of the show just talking about that. But really, what you should do is, if you're curious about note investing, if you're curious about mortgage investing, if you're curious about how you can possibly earn 8%, which I think is a great yield in this incredibly, low and interest rates aren't coming back.
No, they're
anytime soon. They dropped again.
10 years, what, $1.87?
Right, we're going to see, again, we're going to see 3.5% mortgages, in my opinion, in the next few weeks. So if you want information about how you can participate in and be the bank, get the kinds of yields that most people only dream about, give us a call at Pacific Private Money. We're here in the Bay Area. We're at 415-883-2150, or go check out our website. Of course, we have one, right? PacificMoneyFund.com. That's PacificMoneyFund.com. That website is really geared towards our fund, but it also talks about trustee investing as well, so you can get information there. And good luck.
And Mike, didn't you want to ask Mark a question?
I was going to ask Mark how, for the listeners, how he could describe the trustee world in terms of riskiest to less risky assets along the spectrum, because I think we can all agree that in the world of investing, anything other than the the treasury is considered a risk asset, whether that's stocks, whether that's bonds, trust deeds, anything. And so certainly there's something along the spectrum I'd like to learn a little about too.
Well, since I was just talking about mortgage pool funds and individual notes, I'll start with mortgage pool funds. Really, you need to check out and do a very thorough vetting of the fund manager. If you are able to check the background and the reputation and the references, maybe talk to other shareholders, that will be helpful. You really want to do a thorough background check on the fund manager. Now, on individual notes, the first things that come to mind are, first of all, well, what's the loan to value? And is it loan to current value, or is this loan that you're looking at you're potentially investing in is based on a loan to a future value? And what that means is that a lot of borrowers are borrowing money to buy a property to improve it and then sell it at a profit. And we get many borrowers who come to us and say, this property is going to be worth $500,000. Can I get a 75 or 80% loan on that? And so they're looking for basically 100% financing to buy the property and remodel it and then hopefully sell it for a profit, even though they're saying, well, there's still protective equity there when there really isn't. What you want to look for is notes that are no higher than 70% loan to current value or loan to purchase price if it's an arm's length purchase transaction. And as far as risk goes, the lower the LTV, the better, right? That's number one. Neighborhood, number two, 25% or 50% loan to value in San Francisco or Marin has a different risk profile than, say, Alameda County or East Contra Costa County or Solano County, where if we do have a downturn, that market's going to be likely to be affected first.
Well, Mark, what about being in first or second position in terms of the risk profile?
Well, first is always better.
But sometimes what you can do, though, is if some people say, oh, never do a second. The thing is, I mean, I did a second a couple of years ago where I did a $70,000 second on a property that was worth $300,000. The first was only $19,000. So that's not a very risky loan. If anything goes wrong, I'll just pay off the $19,000.
We get a lot of requests for seconds where it's a very low amount of money owed in first position, and they're only paying 2 or 3%, some ridiculously low rate, and they say, look, I don't want to pay that off, and I don't want them to pay it off because I don't want to come across as a predatory lender or loaning them more than they need, because there's plenty of people out there who will absolutely invest in a second. You'll usually, for a couple of reasons. Number one, you'll usually get a higher rate of interest if it's a second versus a first. So we typically do firsts at 8 to 10 and seconds at 10 to 12, for example. And number two, if the combined amount of the first and the proposed second is still, say, 50% loan to value or less, and oftentimes it is, you'd be surprised how much equity people have in their homes, and they're coming to us and looking for a relatively low LTV
Well, the other
second.
thing to look at too is what's the proportion of the second to first. You don't want to do a $100,000 first behind a $500,000.
Or $1 million.
I'm sorry, a
It's the second.
$100,000 second behind $1 million first.
We get those requests too.
That's
We-
ridiculous.
But the way of the mortgage, the
pass
moral
on
of the
those.
story is doing your research. When it comes, the answer can't always be yes or no.
Yeah, it's not.
It
It's not
really
just. A,
isn't.
it's not just a
Though
straight out.
they are, especially in this instance, these aren't necessary for not sophisticated investors, but just educated investors, people who ask questions.
If you
Fair
type trust deed investing into Google or Bing, there's a lot of articles about how to do it safely. And
Yeah.
you need to do your homework.
Okay, very good. We're going to cut to another break. When we come back, we do have a very interesting email for Mike discussing mutual funds that I think people would be interested in. All right, so here's our business trivia third question theme question. What fast food chain founded in 1964 was named for brothers Forrest and Leroy Raphael? Okay, the first three callers with the correct answer are going to win a free 3-day 2-night stay at that Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What fast food chain founded in 1964 was named for brothers Forrest and Leroy Raphael? All right, and stay with us because the Best of Investing will be right back.
Let's go back to TV trivia.
Yeah.
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 Forest and
I mean, what was I
leeway
gonna
with
ask? You know, what does breakpoints mean on a load fund? You can't do that.
What does breakpoints mean on a load fund?
A little too. That's not a yes, no, or quick answer there.
Yes.
Yes, exactly.
Trying to think of all the fast food restaurants.
That's right.
KFC. That was Colonel Sanders. Frederick and Leroy, or what was it?
Raphael.
Raphael.
Well, that's the last name.
It was named after the brothers?
Yeah.
Doesn't make any sense.
There's a little bit of a hint in there. A little bit longer, but it's okay.
Have you already started meeting with the clients already, or they normally? I always think they normally start to come in February when they start to get their W-2s.
My first one is on Monday. But we have that are completed, but I'm actually meeting with another one on Saturday. My hell has started.
Yeah.
That's quite exciting. It's usually about this time of year, I'm like, why?
Hell hath no fury than tax season. Okay, right? There we go. I think
Yes,
my
usually
son.
it picks up a lot.
They tell you my son passed the first part of the CPA.
Oh
exam?
no, good
Congrats
job.
to him, yeah. Okay, here we go. Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host. Mark Hahn, Kathryn Harris, Mike Zaidlin in the studio. It's a full house today. The theme is business trivia. Here it was. What fast food chain founded in 1964 was named for brothers Forrest and Leroy Raphael?
Something that has the word brothers in it.
It's kind of
Brothers
not
Chicken.
exactly, but you have heard of this fast food chain,
All right.
Arby's, and it stands for RB, Raphael Brothers. A little
Oh,
tricky,
man.
little tricky.
Well, let's go back to like the game show trivia and stuff.
or name this voice. Okay, Mike Zaidlin, we have a question for you since you are the financial advisor. It says here, my financial advisor told me that I should buy mutual funds with him that carry a load because he would watch them for me and tell me when to get in and out of them. Does that sound like prudent advice?
No, it sounds like the financial advisor is going to make a healthy commission on the loan, is what it sounds like. Now that's not necessarily a reason to dismiss every possible load fund, but the historical record of fees, commission-based fee products, and mutual funds, as well as ongoing expense ratios, because load funds not only require about a 5% upfront fee, but usually another 1 to 1.5% on an ongoing basis. And if you look at any of the studies done by John Bogle and Nobel Prize-winning economists and so forth, you would find that there's a very low probability that that fund is going to outperform a basic index fund over time, and that's part of your retirement going to someone else.
Okay, so what would you, if the question came in, well, the same advisor said that he is going to get me into no load funds, but he'll just charge me an asset management fee. Because like he's looking and saying, listen, I got to make money one way or the other, so whether I charge charge you nothing and get paid a commission, or I charge you nothing, use a no load fund, but then charge an asset management fee. How do you answer that one?
Well, whether even with load funds, there's typically asset management fees along with that, because an advisor is advising you on it, and there's nothing wrong with an ongoing management fee. I mean, I charge them because my clients need ongoing financial and investment advice. So that's not.
That depends on how much, right? That's what it comes down
to some degree on how much, sure, but whether it's a particular load fund or not, that's really a separate question. I simply think that fees are to be avoided at all costs when it comes to investing. Investing can be done extraordinarily inexpensively. You can buy the entire global stock market for about 1/10 of 1% through index funds.
Oh, okay.
Versus the actively managed mutual funds, which average about 12 times more.
Yeah, I was gonna say because I don't have enough money to buy every single.
Well, you can buy it through 1 or 2 index funds, and most portfolios, I think, can be put together with 6, 7, or 8 index funds.
Yeah, but you don't advise people just go out there and here's a bunch of
No,
index
I don't.
funds cheap.
No, I don't, because
they
it's,
still need some advice.
which particular index funds, which accounts should they go in, as we were talking about earlier with tax efficient investing, where do you put your bond funds? Which accounts should be put in, or which assets should be put into Roth IRAs? Roth IRAs should probably contain the fastest growing assets because they're going to be tax free. Do you have a carry forward capital loss? If so, that means probably more stock index funds can go into your taxable account because you'll be paying virtually nothing on the capital gains, although you'll be paying something on the qualified dividends. How do you coordinate IRA withdrawals with Social Security in order to tax efficient investing is really about a lot of different looking at a lot of different
And can you
things.
believe this? I actually understood every word he said.
But in the right context, though.
I did because I understand the capital loss carryovers and the capital gains to offset it.
I thought I'd throw out a couple fancy tax accounting.
Yeah.
phrases and impress everybody.
And what if you have some investment interest carryover and you have some investment income to offset that? Okay, I'm sorry. Go ahead.
So Mike, I hear this a lot that investing in index funds, especially no loads, is really smart. How is it we still have thousands of mutual fund choices out there?
Well, I can't say that every actively managed mutual fund is wrong for an investor. Sometimes you can have a few. There are times where you may have a very inefficient portion of the market. So, for example, in emerging markets, a lot of the emerging market index funds are comprised of the largest cap companies out there, which tend to be formerly state-owned companies, such as, say, Gazprom in Russia or Petrobras in Brazil or large companies in China, and maybe those are not really the best choices. It's hard to say. I still often recommend emerging market index funds, but you can make a case for active management. However, you just have to go in knowing that, for one, especially in a taxable account, actively managed mutual funds are going to probably be very tax inefficient because the average actively managed mutual fund turns over 80% of its portfolio in any year, generating what I consider to be unnecessary short and long-term capital gains that take, according to the studies, about 1% of the value of the account down.
In a sense, they're kind of timing the market in a way because they're that get in AT&T and out of IBM.
Yes.
So even if you did beat the market, even if you were a fantastic active mutual fund manager or investment advisor who got you in and out of all these, what about the taxes? You're going to not only have to beat the index, you're going to have to beat the index on an after-tax basis. Very, very difficult. John Bogle demonstrated that happens about 3% of the time in a taxable account over 20 or 30 years.
Wow.
Well, Mike, if any listeners wanted to get a hold of you to ask more questions about these mutual funds.
Sure. Well, our website is padronellc.com, and I can be reached at 415-785-4585.
And you can always get in touch with the Best of Investing if you forgot those phone numbers. Okay, we've got just a couple of minutes left. Anybody?
Mike, do you ever recommend individual stock ownership to your clients?
No. I think it's too
Why?
risky.
Oh.
I also think I'm personally too unskilled in being able to say, aha, this stock will beat the market. I think even because, and I say that because the highly skilled people in this industry almost very rarely can do that. So I'm definitely not going to pretend that I'm going to do it. I don't see the point of taking the risk. You're, I believe, much better off just buying broad sections of
You
the
get the
market.
different diversification, right?
So even in the Bay Area here, where we've got all these, glamour tech stocks going
So
IPO and stuff like that, I mean, can you even get in on those? Is maybe one of the questions. Would you want to, really?
Yeah, would you want to? I don't know. I see portfolios where people have come from another investment advisor and who has picked individual stocks, and then I'm left, and my client is left with the problem of, okay, those have gone up along with the market as a whole, and now we have to deal with these unrealized capital gains that we wouldn't have to deal with if it had all been in some index funds. Granted, you'll still pay the capital gains, but along the way you're exposed while you're still in those individual stocks. So even if they've done well, and what's really funny is they'll say, well, we've done really well, and I'll say, compared to what? Your stocks are up 60% and the market's up 80. Did your advisor tell you that?
Compared to being in a 0% bank account.
Right, and now we've got the risk
Now
of
it's risk.
what to do with those stocks, to keep them
Yeah.
and continue carrying on individual company risk.
What do they call it? The beta, when you compare the risk of like someone says, yeah, I was up 60%. Yeah, but the risk you took was just incredible. The beta.
Beta's a measure of volatility.
There you go.
Alpha's outperformance.
So how did the indexes end up doing now that we're into January? How did they end 2014?
I think in 2014, actively managed mutual funds had their worst year ever. 80% of them underperformed index funds. So you see more and more people just getting smart about it. And again, I wouldn't say you never want to be in an actively managed mutual fund, but I think they should carry a cigarette tobacco warning.
Yeah, but here's the other thing.
Don't
is that
do this at home.
Do it, but be aware of the risks.
But then what also happens to the mutual fund that underperforms and everyone starts exiting?
Well, and
That's
exactly.
happened. I remember that happened in the 80s.
Oh, really?
Yeah,
Wow.
I mean, then the mutual fund is forced to sell a bunch of assets. The fees go up internally, and then sometimes they just close the fund. They turn it into a
Well,
closed
and
fund.
Edward, that's a fantastic point because when you buy an exchange-traded fund, typically index funds, you largely control the generation of the capital gain by you being the one who sells it. When you have a mutual fund, an actively managed mutual fund, it is the fund manager and the owners of the fund who determine we're getting out of the market. Those positions need to be sold. Guess who gets a 1099?
Wow. Good stuff. Good stuff, people. All right, we're going to
good
cut to
show.
our thoughts for the day. If a window of opportunity appears, don't pull the shade down. And leaders don't create followers, they create more leaders. I like that one. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Und das war's.